The global financial crisis of 2008 was the most severe economic crisis since the Great Depression of the 1930s. The crisis had its roots in the housing market in the United States, where a bubble had formed due to easy credit and lax lending standards. Many homeowners had taken out mortgages they could not afford, and banks had packaged these subprime loans into complex financial instruments called mortgage-backed securities. When housing prices began to decline in 2006, many homeowners found themselves owing more on their mortgages than their homes were worth. This led to a wave of defaults and foreclosures, which in turn caused the value of mortgage-backed securities to plummet. This triggered a chain reaction throughout the financial system, as banks and other institutions that had invested heavily in these securities began to experience significant losses. As the crisis spread, it affected not just the housing market but also other sectors of the economy. Many businesses were forced to cut back on investment and lay off workers, while consumers reduced their spending. This led to a sharp contraction in economic activity, with GDP falling in many countries. Governments and central banks around the world responded with a range of policy measures, including bailouts of financial institutions, fiscal stimulus programs, and monetary policy interventions. These measures helped to stabilize the financial system and prevent a complete collapse of the global economy, but the recovery from the crisis was slow and uneven, with many countries experiencing a long period of low growth and high unemployment. The global financial crisis of 2008 had a profound impact on the world economy and financial system, and it led to significant changes in the regulatory framework for banks and other financial institutions. Policymakers sought to strengthen the resilience of the financial system and prevent similar crises from occurring in the future, through measures such as increased capital requirements, improved risk management practices, and greater transparency and accountability. Top of form. The financial crisis of 2008 had far-reaching implications for the global economy and financial system, and its effects are still being felt today. Some of the key implications of the crisis include: regulatory changes. The crisis led to significant changes in financial regulation, as policymakers sought to prevent similar crises from occurring in the future. In the U.S., the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010, which introduced a range of new regulations for banks and other financial institutions. Other countries also implemented reforms to strengthen financial regulation and improve transparency and accountability. Economic uncertainty. The crisis had a profound impact on the global economy, leading to a prolonged period of low growth and high unemployment in many countries. The uncertainty created by the crisis has also contributed to a more volatile economic environment, with increased risk aversion among investors and businesses. Changes in consumer behavior. The crisis had a lasting impact on consumer behavior, as many people became more cautious with their spending and borrowing. This has contributed to a slower pace of economic growth in many countries, as consumer spending is a key driver of economic activity. Increased government intervention. The crisis led to a significant expansion of government intervention in the economy, as governments around the world implemented stimulus programs and bailouts of financial institutions. This has raised questions about the appropriate role of government in the economy and the potential risks of excessive government intervention. Heightened risk awareness. The crisis has also led to a greater awareness of the risks associated with complex financial instruments and the importance of effective risk management. This has led to changes in the way that financial institutions operate, with a greater focus on risk management and transparency. Looking to the future, the financial crisis of 2008 serves as a cautionary tale of the risks associated with excessive risk-taking in the financial sector. While many of the regulatory changes introduced in the wake of the crisis have helped to strengthen the financial system, there is still a need for ongoing vigilance to ensure that the mistakes of the past are not repeated.